of Nirmal Bang Institutional Equities, I welcome all the participants to CCL Products India Limited 3Q FY24 earnings conference call. The management is represented by Mr. Challa Srishan, Managing Director, Mr. Praveen Jaipuria, CEO, Mr. B. Mohan Krishna, Executive Director, Mr. V. Lakshmi Narayana, CFO, Ms. Sridevi Dasari, Company Secretary, and Mr. P.S. Rao, Consultant Company Secretary. Without further ado, I would like to hand over the call to Praveen sir for his opening comments, and then we'll open the floor for question and answers. Thank you, and over to you, sir.
Thank you, Abhishek. Good morning, everyone, and wish you all a very happy 2024. As far as the performance of the group is concerned, the group has achieved a turnover of rupees 664.48 crores for the third quarter of 23-24, as compared to rupees 535.3 crores for the corresponding quarter in the previous year. And the net profit stands at rupees 63.29 crores as against 73.06 crores for the corresponding quarter of the previous year. The EBITDA is rupees 112 crores and the profit before tax is rupees 66.69 crores. As far as the 9 months YTD performance is concerned, the year-to-date turnover has been 1926.98 crores as compared to 1551.13 crores last year. And the EBITDA for the 9-month period in this year stands at 329.38 crores as against 287.64 crores for 22-23. The PBT for the 9 months period stands at rupees 205.82 crores as compared to 110 crores last year, and the net profit for the 9-month period stands at 184 crores, which is as compared to last year is 183.59 crores. There are 2 updates which I would like to give it to you. In this quarter, during the last 10 days of the month in December, we faced issues pertaining to Red Sea, which meant that a lot of containers which were ready to be shipped could not be shipped because the liners were not taking containers because of the Red Sea issue. That led to deferment of sales from December to January. The quantity was almost 800 metric tons, which is reflecting in the balance sheet, and since most of you wouldn't have it, that is probably you wouldn't have noticed it. But that's one issue that we faced which impacted performance in the last month. And also there is an update on the insurance that we have claimed for the breakdown in the Vietnam unit, and we have filed the insurance with the insurance company. And as we had informed earlier, it's almost 5% of the bottom line. And as far as the claim is concerned, if we get the claim this year, then it gets reflected. Otherwise, we will wait for the claim to come, and then we will accordingly inform all of you. So that is the update from our side, and I open the floor for questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Kashyap Zaveri from MK Investment Manager. Please go ahead.
Yeah, thank you so much, sir. I hope I'm audible.
Yes.
Yeah. So a couple of questions from my side. One, you mentioned about roughly about 800 tons of material which could not be shipped. That roughly probably translate to about 40 odd crores of turnover.
Yeah, around 45.
And adjusted for gross margin, the full amount would have impacted our EBITDA number also. Right. Second is on, in the last quarter when this, breakdown of equipment had happened, what we had highlighted is that, some pushover of volume from quarter 2 to quarter 3. Now, even if I adjust for this about 800 tons, that pushover of that volume ideally should have helped us, achieve a fairly strong volume growth in this quarter, which is probably not visible. So, what explains that?
Okay. So there was no pushover from quarter 2 to quarter 3. If you remember what we had explained in the last quarter, because of the breakdown in Vietnam, we had said that we would try and be a little more aggressive in this quarter to make up for the volume as much as possible.
Right.
But so so there was, it wasn't so. If you see this quarter, you will see that we are at around 14% volume growth, and if this 800 tons would have come, this would have gone up to approximately 20-21%, and we could have made up a little bit in this quarter. But there was back-to-back issues that happened in both the quarters. Otherwise, things would have been better as far as numbers are concerned. But having said so, even in spite of the Red Sea issue, we did manage a 14% volume growth, and we expect all of that to get translated in quarter 4. And hopefully, as far as the top line guidance is concerned, there won't be any change in terms of our growth trajectory. Probably yes, this 5% of profit loss that we probably were got impacted because of the breakdown, that could lead to certain kind of a profit re-guidance. But that will again depend on on the claims, etc. So broadly, the guidance remains the same. Yes, this impact we will be able to know only by the end of the quarter.
Okay. And connected question is that, let's say this Red Sea problem persists and, we have to use a different route. Who bears the expenses?
So, Kashyap, as far as we generally have two kinds of contracts. So for the FOB contract, of course, the buyer bears the expense. There are certain contracts, approximately, 30% of our contracts are CIF contracts. So, of course, that expenses will be borne by us. And that in fact could lead to a little bit of compression in the EBITDA margins.
Okay. And some bookkeeping question: can you give the gross debt as well as the inventory, receivable, and payable numbers for the quarter? Can you share that?
I'll just ask our CFO to give you the numbers.
Sure.
So the debt as of now, it is around 1,300 crores.
Okay.
Okay, and the receivables are around 60 days, and the payables are 60 days.
I can't hear you clearly.
No, the receivables are around 60 days, and payables are at 15 days.
Okay. And including this additional inventory of about, let's say, 40-50 crores, what would be the inventory number?
Inventory, it was almost around finished goods, if we take it around 130 crores.
Sorry, I didn't get that.
130 crores. 130 crores.
Additional versus previous quarter.
Yeah. Total, as on 31st December, which would have been less by selling it off that 800 tons, which is maybe around 35 crores less. We might have ended around 102 crores.
102 days, right? Not crores.
102 crores by selling it off another 800 tons, which we are supposed to.
Okay. Sorry, I'm getting a bit confused. So, can you give me exact inventory number on balance sheet as on 31st of December?
It is on finished goods. It was 135 crores.
Okay. And other inventory, raw material as well as finished goods?
Raw material, we have almost around group level around 400 crores.
Okay, got it. Yeah. Sorry, that's it from my side. Thank you.
Okay.
Thank you very much. The next question is from the line of Amol Rao from Kitara Capital. Please go ahead.
Good morning, gentlemen. So just, couple of questions on the outward freight side. Now, as the previous participant asked, that we might incur some additional expenses for the freight for our CIF contracts.
does the export time also elongated? So should that reflect a little bit in our receivables also? Because they're going to take a longer route, right? So
yeah, so it's more 4 to 5 days. It's not really, really needle changing. Yes, but there will be a little bit of a delay. So 5 days of more delay if they go through Cape of Good Hope. That could impact a little bit. But these are little impacts. We are not showing at a larger level. Things will change drastically for us.
Okay. And so another question which is has a larger scope. There is no deferral of demand, right? The demand remains intact. It's just meeting that demand that is taking a little longer from our side, right?
Yeah, there isn't any issue with the demand, and the demand remains intact, and it looks like there is in fact a more pent-up demand which is getting reflected in the coffee prices as well. So we are not seeing any sort of issue with the demand side. That's been more of our supply constraints that we have internally. Otherwise, demand is intact.
So if I may just squeeze in one more question. So the last time we spoke in December, you alluded to coffee prices being at 3-decadal highs. What's the sense you're getting on the Vietnam crop? Are the prices still elevated in anticipation of the poor rains, or anything you're seeing on that? Anything that you could help us with, on that front?
Yeah. So in fact, since the time we last spoke, the coffee prices have gone up quite a bit. It is almost at an all-time high and unexpectedly high because nobody expected these kind of prices. So yes, there are two things. One is, as we spoke earlier, the demand remains robust. There is a huge demand of coffee which remains intact. But yes, there are issues in terms of supplies because of probably poor output of the crop, or at least there is a perception that there are poor output and there are fund guys playing into this. The coffee farmers are wanting to hold stock because everybody is more of a upward trajectory mode. So all that is leading to high coffee prices. Future outlook, all our outlook has gone wrong for the last 2 years. So very difficult to predict which way it will turn around. Probably takes a trigger to turn things around. But as of now, in the short term, we don't see any sort of price indication that which side it will go. Looks like it will remain at these levels for some time.
And in the middle of all this chaos, our business model remains intact. That is, we book the coffee back to back when we get our order. Right?
We don't. Business model. Yeah, there is no change in our business model. We kind of book back to back, and we don't kind of buy coffee unless until we have orders.
Got it. And sir, on the expansion side, are we on track with our expansion in India, which is basically going to come in probably in October, November of this year?
No. India expansion wasn't October, November. It was March. So that is on track. The Vietnam expansion was July, September quarter. That is also on track. So
that is on track.
On track for both the expansions.
All right, sir. Thank you so much and wish you all the best.
Thank you.
Thank you very much. The next question is from the line of Shirish Pardesi from Centrum Broking. Please go ahead.
Hi, sir. Good afternoon. Thanks for the opportunity. I have a few questions. You mentioned that 14% volume growth. Can you break that growth for India and Vietnam? And a second question is that if you could talk something about India branded business and the institutional part of the business and modern trade. So maybe segmental, what kind of growth you have seen in the quarter?
Right. So first of all, answering the first question, the India volume growths were in fact we declined because if you remember last year we were doing third-party buying and all that, and also add to it the deferment that happened at the end of the month. So there was almost a 10% or 10% decline. And Vietnam capacity is almost at a 40-50% upside because of the new capacity and the aggressive selling that we were doing. So this is the breakup of these two segments. As far as India domestic business is concerned, India domestic business for the 9 months, we almost did done approximately 230 to 235 crores, out of which the branded business itself is approximately 145 crores. If you remember, for the last year, we had done full year of 150 crores of branded business. We were able to touch in 9 months. Projection-wise, this year we are looking to touch the 200 crore mark for the brand alone, and 320 crores or so for the full domestic business. As far as channel growth, I think most of the channels are growing at the same momentum. The brand currently is on a 40-50% kind of a growth momentum after a bit of correction in Q1, Q2. And we are seeing this kind of momentum happening from all the channels, both all GT, MT, as well as e-commerce. So yeah, it's been an all-round growth for us.
And I think last time you mentioned that our touch points is somewhere around 1.2 lakh and 80% is residing in South. So any update as of December, how it is panning out?
No, so every quarter we kind of add around 2,000-3,000 outlets that we are continuing to do, and we are now kind of last time we have given an update that we are now aggressively trying to expand in other parts of the geography beyond South. So as of now, today in almost all 10 lakh plus population town, we have our distributors set up. So that expansion we are taking, and we are building on some of the other, other brands. So in South we sell Continental Extra. We are building Special in other parts of the country. So all that is happening, and it's been an all-round kind of a growth happening. So in South we are trying to penetrate deeper. So we are now probably touching almost all towns above 50,000. So that's been our strategy: go deeper in South and kind of expand to key geographies in North and key towns, because in other parts of India, coffee is a very urban phenomena. So that expansion is an ongoing process, and we are taking it on.
Okay. My second last question on the UK acquisition logbook. Any update at this time, which is you can quantify how it is panning out?
So in terms of numbers, we are probably we would do very. In fact, there was a period of changeover, and which happens in any acquisition. So from July onwards, we started taking things onto us, and then we started reworking on the product, packaging, and all the promotions with our UK partners. And we took around 4-5 months to kind of stitch everything together. We are now good to relaunch. March end is when we are looking to relaunch with our new packaging, new product, and new strategy at all stores in UK. So this year's numbers will not be much. It will be approximately 15 crores or so. But then after March relaunch, we'll be able to update that how the relaunch has been appreciated in the market going forward. But yeah, a lot of work happened during this interim time in terms of relaunching the whole proposition in the market.
My last question on margin front. We have been able to hold on between 40-41% gross margin, while the EBITDA has been a little on the lower side. So in the medium term, what are the pain points where you think, you touched upon the coffee is still looking inflationary, but is there any margin room for growth for us, and how we should look at the next year margin?
So, like last time we had pointed out, there is no apparent or very distinct, reasonable kind of a deviation that we are looking at margins, because there are 2-3 factors or 4 factors that will play up. One is definitely is the product mix. So if you would have seen our product mix for the current expansion and the expansion which is coming in India, will be on the spray-dried side, and spray-dried you earn a little less margin than the freeze-dried side. Then what will happen is next year, September onwards, October onwards, the freeze-dried capacity will come, so that will improve the margin. On the other side, we are also trying to focus a lot more on small packs, which helps us give better margins. We are looking at specialty coffee, which will help us. So, there are a lot of factors which are going to play around. There are some factors which will pull up the margins, some factors which will bring down the margins. So on an overall consolidated levels, we don't see much of a change in the margin that is going to happen in near future. But yes, going forward, once things get stabilized, once your mixes get stabilized, once some of our initiatives regarding small packs, specialty coffee, they all start coming into play, then we probably will start seeing improvement in margins as well.
Thank you, sir. Wonderful, and all the best to you.
Thank you.
Thank you. Next question is from the line of Akshay Cheda from Canara Robeca Mutual Fund. Please go ahead.
Yes, sir. So thank you for the opportunity. Sir, two questions. So first question is, sir, you said that 14% volume growth, but EBITDA growth is only 10%. So what explains the 4% gap? Because ideally we keep guiding that the EBITDA and the volume growth should go in hand. So, sir.
So, Akshay, actually, it's EBITDA growth is, if I'm not wrong, around 11%, yeah, and it's 14%, so there has been a 3% drop. As I mentioned a while ago, the 3% drop is because in our volume mix, we did aggressive selling at Vietnam, because not every product fetches you the same kind of margin. So what we did was, because we wanted to fill capacities and make up for the losses that we had in quarter two, we did some low margins contract as well in Vietnam, which led to a little bit of a squeeze in margin, which you can see in terms of 2 to 3%. But in overall scheme of things, if you see YTD, there isn't much of a difference. We are actually, there is 12 to 13% growth in volumes and 15% growth in EBITDA. So we are probably, at a YTD level, we are intact. And as I always have said that, at a quarterly level, these mix changes and all that could come into play, and therefore you may see some variations. But on an annual basis, our guidance remains intact. Volume growth and EBITDA growth will be always intact.
Okay. So second question is, sir, if we see the second and the third quarter, so at least the EBITDA growth was around 13 and 10%.
Right.
So, but on the annual guidance, does that 18-20% volume growth still hold true, or so we'll have to curtail that to some extent, because at least the second and third quarter we are lagging a little bit?
Yeah. We are lagging, but actually a couple of things. One is that volume growth, we are pretty confident that we'll be able to get to that 18-20%. In terms of EBITDA, because of that, that loss in quarter two at Vietnam,
Yes.
and subsequently when we are trying to cover up, obviously, as you're seeing in quarter three, there is a little stress on margins because we want to aggressively cover the top line. So there could be certain, drop because we may not get the insurance claim this year. It may happen later. But broadly, if we were to get that insurance claim, that guidance of 18-20% remains intact, both for volume as well as for EBITDA.
Okay, sir. Sir, this was very helpful, sir. Thank you.
Thank you very much. The next question is from the line of Abhilasha Satale from Quantum AMC. Please go ahead.
Yeah, thank you for taking my question. So I have one question in terms of working capital. So can you just throw some light what is the impact of Red Sea issue on our overall working capital in the near term? You can just give, approx the numbers in terms of how much you are seeing the impact. And secondly, as our Vietnam capacity stabilizes, what kind of working capital outlook we are seeing for that? Because, in the last 7 or 2 years, we've seen some increase in working capital, maybe because of the different issues. But as we stabilize all our capacities, what are the working capital days, what we will be comfortable with? This is my first question. Thanks.
Yeah, if you look at it, the kind of revenue growth and the volume of the production that is happening, we have aligned with the enhancement of the working capital facility in India by 200 crores. And whereby now the 400 crores working capital loan, it is likely to increase to 600 crores in India. And regarding the non-coffee Vietnam, wherein the new capacity has come into operation. Earlier, we have almost around 15 million USD working capital exposure. Now it is going up to almost around 45 million, which we have necessary arrangements have been taking place. As a whole, if you look at it, the working capital is likely to be from earlier 600 crores, it has gone up to 1,000 crores.
Okay. So, are we seeing, are we taking any measure to bring it down as this facility stabilizes? So, over the next 2 years or so, maybe, in percentage of revenue and all, where would we like to, or what is our target to stabilize our working capital at?
So now we are at the peak level. It is likely to go up another 200 crores maximum by next year. But post that, it is the free cash flows are going to be available. Then we keep reducing it.
Okay, thank you. And my second question is, what is our burn on branded segment in 9 months FY24? And can you give some roadmap towards profitability for the segment?
Can you just repeat? Your voice is a little, it's not very clear.
Okay, is it better now?
Yeah, better now. Yeah.
Okay, so my second question is how much is burn on branded segment in 9 months FY24, and can you give some roadmap towards profitability for the branded segment?
Okay, so first and foremost, there is no burn there because last year itself we had indicated that we have broken even, and probably from this year we will be at 5-6% of 5-6% EBITDA levels, which will keep increasing as we go along. But yeah, the fundamental principle here will be that we will try and invest as much as possible back into the brand because we really don't want to slow down the momentum at this stage when the brand has got that momentum and is getting into that threshold levels of being a fairly largish brand. This year we are looking to end the year at just the brand segment at 200 crores. So that's a very, very big milestone because there are not many brands who kind of have achieved this kind of a milestone in this short period. So we really want to keep up the momentum, keep investing back into the brand. But yes, 5-6% of EBITDA is definitely there right now, and we will see how we can improve it. But with this thing that we really want to right now be invested in brand building.
Sure. I appreciate, but I think at PAT level, we would still be burning if I'm not wrong.
No, so after so there isn't much of this thing PBT. There is no this thing. The brand demerger has happened, so there aren't any in loans to be serviced or it's not asset this thing. So there isn't any depreciation or anything. So there is not much of difference between an EBITDA levels and PBT levels. So except for the vending machines that we buy, we probably have a little bit of depreciation and interest, but those are very, very less in number. So there won't be much of. So if the EBITDA levels would be at around, let's say 5-6%, the PBT could be at around 2-3%, and the PAT will not be getting impacted so much. So therefore there isn't any burn even at the PAT level also.
Okay, sure. Thank you. Thanks.
Thank you very much. The next question is from the line of Ankit Kanodia from Smart Sync Services. Please go ahead.
Thank you for taking my question, and apologies if these questions have already been answered. You may skip it. My first question is related to the tax outgo. So suddenly we have seen a very big drop in taxation this quarter. Can you throw some light on that?
So here, if you look at it standalone, we are falling under MAT because of the carry forward MAT credit. The effective tax rate it is in India is working out 7.75% and as you know that in US now it is a tax free, corporate tax is completely exempted. Thereby you could see that drop in the overall effective tax rate. And as we informed earlier also, the effective tax rate at group level, it is around 12%.
Okay. Thank you so much, sir. That is it from my side. And all the best.
Thank you very much. The next question is from the line of Senthil Manikandan K. from iThought PMS. Please go ahead.
Good morning, sir. Thanks for the opportunity. My first question is with respect to the vending machine business. So if you can just share what's the broad strategy behind over the next 3 to 5 years in building this business in the domestic market.
So, vending business, we approximately today have 4,000 vending machines that are operational across the country. And we are looking to build aggressively. See, this is a very, it's a tricky business as well, because vending machines, everybody in the market wants you to put, without any cost, and then they might end up also buying from somebody else once they get the machine. Because obviously there will be local players and traders who probably offer at a very dirt cheap rate and things like that. So that is why we have been very careful on this front not to go overboard. Today we are making sure that it's a self-sustaining model. In 6 to 7 months, most of our vending machines kind of pay back for themselves. So keeping all this in mind with the new approach, we are looking to scale it up and but in a more sustainable manner. In terms of the business that it will generate, of course, we're looking to build up a business out of vending itself to 100 crore kind of a business in the next 3 to 5 years. Today it could be around 20-25 crores or so. But yeah, that's been our plan and that's been our strategy as far as vending is concerned. In fact, last time we had also kind of apprised all of you that there is this whole out-of-home consumption that we want to tap into and drive this whole out-of-home consumption a lot more deeper. And there are certain experiments that we have been doing. We have been, opening kiosks. We are about to open some cafes as well and do the proof of concept of, penetration driving as far as the cafe concept is concerned. So all that work is happening as far as the out-of-home consumption is to be given.
Okay, sir. Thanks. Second is a related question on the domestic market in terms of our presence in the coffee retail chains. So of late, we have seen that a lot of startups like Third Wave Coffee or they're making a good presence in the market. So what's our presence and strategy in this line of business?
So, I'll just give you a brief background. As far as all the coffee startups today, if you see the India ecosystem, as far as coffee is concerned, probably a large part of it is driven by us. So a lot of these coffee D2C brands and these startups you see, whether it is brand or whether it is the chains, we are doing a lot of back-end work with them to drive, because our whole concept has been that how could we drive a lot more coffee consumption in this tea-drinking country. Yeah, so that's one. Second is in terms of our presence. If you see, our presence far outweighs all the brands, in fact, put together. Most of these D2C brands are probably in the range of 25 crores or so. And we are probably will be reaching 200 crores this fiscal. So you can kind of, compare the kind of presence we have. So if you come to, south of India, and if you start going to retail outlet, you'll see that our presence is as a very strong number 3 brand in most of the retail outlet. And there are certain pockets where we are, seen as a number 2 brand. So that is the kind of, presence and visibility that we have been able to achieve. Yes, the next milestone would be to get this kind of presence and visibility in the north, east and west markets as well, for which the work has started. There are a lot of outlets where we are now fairly visible in these zones as well. So that's a brief outlook of our presence in the retail market.
Okay, yeah. Thanks for the answers. That's it from my side.
Thank you very much. The next question is from the line of VP Rajesh from Banyan Capital. Please go ahead.
Hi, thanks for the opportunity. Just a clarification, when you're talking about 200 crore of brand revenues this year, does that include the vending machine business also, or if not, then what is the...
It includes branding business, because all the vending machines is a branded these things we all sell under the brand, so that is part of the brand. Bulk and private label is outside this.
Okay. And out of 200, how much will the vending machine business be by the end of the year?
Approximately 20-25 crores would be that. The rest of it would be products.
Okay. And then in terms of the products, as you were describing, that you are either number 2 or number 3 in most of the southern part of the country. So my question is that how is the competitor, the leader or the number 2 player reacting on the ground to your surgeons in those particular markets? Are they trying to dislodge you by discounting, or what's going on? If you can just give some commentary on that side.
So, we are fighting against, the top 2 multinationals of not the country but of the globe. And obviously this thing would be to be aggressive. They hate to lose market shares. But, what we are doing is we are constantly focusing a lot on consumer offtakes. Because once the offtake starts happening, it becomes really difficult for you to be, even if you are very aggressive in terms of doing channel discounts and maybe consumer discounts. Once you are building loyalty for your consumers, what happens is that that ability for your competition to kind of bring you down that much reduces. So that is why we are doing a lot of activities in terms of building consumer loyalty. We are doing a lot of ATL activity combined with a lot of sampling that we do on ground, which is making, a huge consumer base for us. In fact, one of our largest selling packs is the 200-gram pack, which is not the largest selling pack of the category. So that gives us an indication that we are building a very strong consumer base, and that is helping us ward off all the competitive pressures that may be coming from the competition. But yes, competition has been reactive. They are doing a lot of things. But consumer is the thing that we are focusing on, and we think that we are doing the right thing. As long as the consumers are picking up your brand, I don't think so any of the pressures would kind of work.
Got it. And then just a quick follow-up on the online side. How would you rank yourself, and who are the what is the market share that you would ascribe to ourselves vis-a-vis these 2 large players or other D2C brands that you were talking about earlier?
No, come again. On which side did you say? Online side.
On the online channels, yes.
Yeah. So of course, online channels, again, we are very, very, very sustainable on that. Today, if you see the online channel, there are 2 sets of products that sell. There is one set of products which sell because there is an offline equity that is getting built for the brand. So that if you see the large players and including us, which is Nestle, Unilever, and Continental, I can count it now in the same basket. Our online sales are largely dependent on the offline equity that we are building. But if you see the D2C brands, their online sales are largely from the huge amount of money that they have to spend online itself. So therefore, you'll see it is becoming a very, very tough for each of these brands to sustain the online sales itself. And if you were to kind of search for the ROC data for some of these D2C brands, you will yourself see the kind of losses these brands end up making. So anyways, I don't want to go into that side. But that's been our strength. We have been very strong on online. But the good part is that, I spend 1 rupee to get 3 rupee revenue in online, whereas most of the D2C brands, if you see the D2C ecosystem, their ratios have been upwards of 1, which means that the profitability really gets reduced. So that's been our strategy. We are very focused on online. Today, almost 10% of our sales, which is approximately, out of 200 crores, 20 to 25 crores is coming online, which is equivalent to some of the large D2C players who are much talked about in the market. But the only difference is that we don't go tom-tomming about it. And the second thing is that we are building it very, 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 very sustainably.
No, that's wonderful. Thank you for all the commentary. Just one follow-up. Do you have any market share data on the online side? Like, where would you stack up among top 5 or top 10 players?
Very difficult to get online market share data because But our sense is that, from whatever talks that we do to with the category managers of the online space, we probably would be close to around somewhere. My sense is that 8 to 10% could be our share in the online space that we are into.
Great. Thank you so much and all the best.
Thank you.
Thank you very much. The next question is from the line of Bhargav from Ambit Asset Management. Please go ahead.
Yeah, good morning, management, and thanks for the opportunity. My first question is it possible to share what is the gross margin and advertising spends in the branded business?
On a broad level, the gross margins would be in the range of, so the domestic market, we look at it as a whole, it's approximately 30%. The brands would be 5 to 7% higher. And our advertising to sales spends is roughly around 8 to 10% as of now. So that's the ratio on the advertising spends. Yeah.
Okay. And as you scale up your branded business, is there a plan to sort of separately list also that entity? Because essentially now that it is part of the B2B business, it may not get fully valued. But once scalable, is there a plan? And if there is a plan, at what level would you be looking to execute that plan?
So as of now, we want to kind of, in fact, it was under a separate subsidiary which we kind of demerged it back to the parent company because the leverages are much better for us to drive when you are doing it from the parent company. So we really want to go very, very strong on this segment, kind of build this segment over a period of time. As a vision for the company, we have already kind of earmarked that CCL going forward next 5 years, 10 years, 15 years should kind of transform itself into a true blue FMCG company with a lot of brands, getting launched and a lot of brands getting sold. So that's our vision, and we want to kind of translate this vision from the parent company itself. So that will be a strategy. So in the short and medium term, I don't see any such kind of an effort from our side.
And sir, in terms of debt, we have a debt of about 1,000 crores on the balance sheet. When do you plan to become debt free?
It will take around 3 years or 4 years from now to completely become debt free. But that's it's a little hypothetical question because as we move along, as the growths are coming, we really don't know when the next expansion is going to come. But if suppose we were not to expand and there is no new capex that is going to come our way, it will by 28 or 29, which is 4 years, or let's say 4 years from now, we should be debt free.
And so lastly, what would be the share of China in our overall revenue pie, and do you think that number can significantly grow from here on?
Very negligible right now, very minute quantities we sell right now, but last time we had indicated to you that we are kind of partnering with one of our old associates, and we are building that market. So that market right now is in the seeding phase. So right now there aren't any significant volumes that are coming, but we expect these things to pick up as we move along, and we'll keep you updated as the volumes pick up from that geography.
Okay, sir. Thank you and all the very best.
Thank you.
Thank you very much. The next question is from the line of Dhruv Bakhai from RSPN Ventures. Please go ahead.
Hello. Thank you for taking my question. So can you throw some light on quarter-on-quarter and year-on-year figures of EBITDA per ton and the overall capacity utilization that you have been able to achieve?
I'm sorry, I'm not able to hear you clearly. Can you just repeat?
The quarter-on-quarter and year-on-year figures for EBITDA per ton and the overall capacity utilization that you have been able to achieve.
So EBITDA per ton, it remains exactly the same as before. There is a little drop in quarter 3 because we were selling a little aggressively. But, as we had explained earlier, that the spray-dried EBITDA per ton is approximately 90 to 100, and the freeze-dried is around 130 to 135. So that remains intact. As far as capacity utilization is concerned, the India capacity is fully utilized. And when we say utilized, obviously it won't be 100% of the rated capacity. It's generally at closer to 90% or so because of the changeovers, because of the kind of blend that you are doing. So India capacity is fully utilized. Vietnam is also, last quarter we did the optimum utilization of the capacity. There are, it's a new capacity. There are certain line balancing and all that is pending. But, barring that, we did optimize fully the Vietnam capacity as well.
Okay. And so one more question. What are your CAPEX plans for financial year 25 and 26? Financial?
There's no new CAPEX that is there. Already we have announced CAPEX. There is a 50 million this thing in Vietnam and another which is the freeze-dried facility, which is already on. And when I say on, the setting of the plant is on. It will be operational from next financial year quarter 2. And the India facility, the spray-dried of 16,000 tons, that's also close to $50 million CAPEX. So that is also ongoing project. And by this year end, by March end, we should be operational.
Okay. Thank you so much, sir.
Thank you very much. The next question is from the line of Rohan Gupta from Nuvama. Please go ahead.
Yeah, hi, sir. Good morning and thanks for the opportunity. Sir, a couple of questions from my side. Sir, first is on the pressure which we have faced on Vietnam with the aggressive pricing you mentioned, which has impacted our margins. This was, sir, it was just a one-off, or we see that in our focus on driving the capacity utilization at Vietnam plant to full utilization, we may keep on seeing this kind of margin pressure even going ahead as well. That is one. And second, sir, across the globally, which are the markets you see that US and Europe are still facing pressure where we are not able to push the materials significantly?
So first thing is that, there is a bit of a margin drop because of our aggressive selling. One-off is that terminology may not be exactly right, but yes, it is very short term because once you start building clients and when you start building businesses after you have done your or filled your capacity or optimized your capacity, then you can start kind of, improving on your margins. So because, the more the utilization I get into, my pricing becomes even better because my overheads and all that gets, distributed to a larger volume. So it's a short-term thing. Definitely the margins will catch up. If you see the YTD numbers, the margins are completely intact. It's only in this quarter that we saw a little bit of a stress. Then coming to which markets have been a challenge, I don't see that any markets have been a challenge for us. It's more that we don't have the capacity or we didn't have the capacity to expand to some of the markets. We would have ideally expanded. North America is doing well for us. Africa, small packs, we are doing well. Europe, we are doing well. Even Russia and CIS countries, we are doing well. So I don't see any, and as we discussed and I updated you, Far East, which is including China, we are seeding the seeds right now and hopefully we'll start seeing the volumes coming there. But it was never a question of a demand of our ability. This thing was more of our capacity issues that led to, not touching some of these markets. But we are okay to kind of good to go once the capacity is not there.
Sir, second question is on our margins in spray dye. You mentioned roughly 90 to 100 and freeze dry roughly 130 to 135. I think that we were earlier focusing on with our small packs division doing very well. We were looking at $1.5 to $2 margins on an overall basis of the company. So when you think that we will be reaching to those, 1.5 to $2 kind of margins on an overall company basis?
We will actually, the exact timing is very difficult because, a lot of work is going on small packs. What happened is that, if you see the pre-COVID time, our small pack ratios really increased to almost 24-25%. Then COVID happened and the small packs really declined, and then we focused more on bulk packs. It was almost, work starting from scratch post-COVID. So now we are back, to approximately 18-20% of small packs as we speak. Once we get into a level of around, 30% or so, then we start seeing the real value flowing into the balance sheet, the P&L. But as I was telling a few minutes ago, is that in the near short term and in the medium term, there are other things which are also playing up. So what is happening is that our spray dried capacity is going up, the mix is changing. So we are selling more of spray dried, which has lower margins. Once the freeze dried comes, then that margins will again start improving. So all this, so there will be certain pluses, there will be certain minuses that will play up, and therefore with the short term, we don't see much of a improvement in margins per se. But what we are definitely seeing is that because of our aggressive top line and volume growth, the driving of EBITDA numbers will be through this volume growth. Yeah, and then subsequently, when the next phase comes, we will start driving improvement in margins, and then you will see a lot more improvement in margins, and then we'll see how it goes. Because next couple of years, we are very, very focused that we will drive all our EBITDAs and profits through higher volume growth.
Okay, so commissioning of this spray dried by end of this year will probably may pull down the margin a little bit, but then once again freeze dry commissioning in FY25 may pull up the margin, but for next 2 years at least, we are going to see the volume-led growth only rather than any margin expansion.
Absolutely.
Sir, just coming on the domestic business, if you can just share some number that the retail sales, sorry if I missed it out, but the retail sales number from the different channels in the current quarter and the 9 months, sir.
So basically 9 months I'll share because that will give you a better picture. So the domestic business in the 9 months is 230 to 35 crores, out of which 140 crores is approximately the retail, the branded business, yeah. And we are looking to end the year, the domestic business at around 320 odd crores. And the brand business will be around 200 crores. So that is the yearly outlook for the brand business.
So any idea if you can just share that in our retail brand at 200 crore, what kind of market share we may have at that number?
Right now we are very small, so even when Nielsen picks it up, there are errors and all that picking up. But if I see our market share in the South market, which is like 65-70% of the coffee market, because that's the data we buy, so I can share a bit of that with you, is approximately 3.5%. Yeah, and at an all India level, if I were to translate this because I don't have the numbers, so it could be around 2.5%. But definitely there are pockets where we have done, really well. So our market share in, let's say, AP Telangana would be closer to 8 to 10%. Karnataka would be around 5-6%. Tamil Nadu would be around 3-4%. So that's a little brief on our market share.
Thank you, sir. And just one last bit, and I may come back on a follow question. You mentioned that on your debt number that if you don't go for any further capex from here, excluding this $50 million commissioning in over next 8 months to 9 months, if you don't go, then you are going to repay. I mean, your company will be debt free in next 4 years, right? So that doesn't include the growth which you will be doing with the volume led and the working capital requirement, or that includes that, and including the working capital will be debt free.
No, this is term loan, long-term debt is concerned, it completely gets free by 29 with a schedule of repayment. And working capital also, you will have some ease in working capital as well because the free cash flows are going to flow into it.
Okay, so even you are saying that actually from the current growth plans, you can be debt free, including working capital. I mean, short term, long term, both.
Not debt free. It's not a debt free. There is some easiness there from the present level.
Okay.
So long-term debt, it is going to be, definitely it is going to be debt-free on account of long-term.
Okay. That's it from my side. Thank you so much, sir.
Thank you very much. The next question is from the line of Rakesh Wadhwani from Monarch AIF. Please go ahead.
Hi, sir. Good morning to the team. So one question with respect to the standalone business, we witnessed a volume decline in Q3, but there's a gross profit increase. Any reason for that?
So, there was some better margin business that happened in this quarter. There was a bit of more of small packs that led to better efficiencies. Therefore, that drop in profit is not there, in spite of drop in volume. Yeah.
Okay. And sir, the EBITDA margin EBITDA growth has come down. Is it because of the shift in the or delay in the packaging shipping? Because the gross profit has been growth is 17% and the EBITDA growth is only negative. So is it because products were manufactured but they couldn't be shipped? Is that understanding correct?
As I mentioned in my opening remark, that there was approximately 800 tons of product which we could not ship because of the Red Sea issue and during the end week of December. Unfortunately, the Red Sea issue happened at a time when the quarter was ending. So that led to, loss in business. So that impacted our P&L.
Okay, one last question from my side, sir, regarding the debt. So you mentioned if there is no expansion plans in the coming year for the next 1-2 years, then the debt, long-term debt will be zero by FY28 or FY25. But I just wanted to know if we expand also the amount of cash flow that will be generating will be sufficient for us to fund the capex on that. Is that understanding correct?
Very difficult to comment right now because there will be working capital debt and things like that. So volume will increase. So we'll have to see the situation at the point of time when we are expanding. Will that debt get serviced through our internal cash flow accruals or not?
The reason I'm saying because over a period of time now, as the coffee prices are at the peak, in a 2-3 year cycle, the prices will also come down in the coming year. May not be doing FY25, FY26, but they will surely come down. My understanding. So that's why I'm asking.
Yeah, absolutely. So if the coffee prices and all that, they calm down significantly, then, the situation will change. Free cash flows will be far higher far higher in the sense it won't be, but it would be sufficient to not only kind of ease the working capital requirement, but also kind of fund some capex also. So yeah, absolutely you are right. If that happens, therefore the reason we are not commenting is because we really don't know how the prices are going to kind of pan out in the next 2-3 years. Really at that moment, how things are will determine how are we going to fund the capex if at all we decide to.
Yes, sir. And sir, can you talk about?
Can you please rejoin the queue? I request.
Sure. Thank you, sir.
The next question is from the line of Kashyap Zaveri from MK Investment Manager. Please go ahead.
Yeah, question pertaining to your debt. The interest cost has gone up from about 11 crores to 23-24 crores, in last 4 quarters. I would, one question is that, how much has cost of, borrowing risen by? And the connected question is that, much of this borrowing would be for our expansion also. How much of even further interest cost has been capitalized in last 12 months or so?
So if you look at it, at Vietnam, the expanded capacity has been completed in March 2023. Thereby, the loan of 20 million which we have taken for that facility, the interest has been accounted for in this current financial year. That is one of the reasons increase in the rate of interest, the absolute value of the interest. And the second is, if you could see that the increase in the total overall working capital borrowings has also increased with the volume of the business that is gone up. Number two. Number three is the rate of interest also is changing. As we all know that it's all most of the export borrowings are linked with SOFR. SOFR is not yet eased out, and because of these three reasons, so there is an increase in the overall interest cost.
And how much is capitalized this year?
This year is nothing because the capacity has been completed last year itself. So this year is totally accounted in the revenue.
Okay. Got it, sir. Thank you.
Thank you very much. The next question is from the line of VP Rajesh from Banyan Capital. Please go ahead.
Yeah, hi. Thanks for the opportunity again. Just this 200 crore domestic business that we were talking about, in the next, let's say, 5 years, where do you think this business could be?
Yeah. So, we are trying to aggressively grow the business. Last time we said on an annualized level for the next 3, 4, 5 years, we are looking many say 30-40% growth, maybe even more. So that's the kind of trajectory we want to maintain. So with that, this thing we are looking to kind of, double every 2 years or so from here on. But definitely as you go along, once the bases get built, you're getting bigger, the kind of growth that you are having now also becomes challenging to maintain. But yeah, we will be 200 crores this year. We'd like to double it in the next 2 years or so. So that's the kind of trajectory we would like to maintain. But this is very difficult to put. I always say that these are very challenging questions itself, because it's a very nascent business for us. Come to think of it, we probably were never into FMCG business 5 years ago. Yeah, so.
Right.
A company which has gone into FMCG business and has kind of attained this kind of scale itself has been a great trajectory. And the kind of things that we are wanting to do, we did explain not only products, we are trying to expand geographies. We want to see that can we launch it in some other parts of the world. Concall we acquired. We are looking to get into retail. So there's lots happening. So really, of course, some of it will work, some of it may not work. We'll have to change track and trajectory. So all that will happen. So, to get to a number is something which is very difficult to say. But can we get to a momentum and keep driving this momentum so that we kind of, see these kind of aggressive growth? Yes, we are committed towards that. And not only in terms of our intent, but also in terms of resources. That is why I keep saying that, next couple of years, we are not intending to improve on EBITDA margins that the brands earn, but plow back everything back into the brand to grow this business.
Understood. And just last question on the B2B side, do you potentially see yourself acquiring some other converters out there globally, or the idea is always to put your capacities and the growth through that route over the next 2-3 years, while your greenfield capacities are coming up?
Yeah. So, it's a little distinct question. It's and buts kind of a question, because, acquiring capacity is not an issue. There are offers that keep coming our way. But if you remember, when we talk about our competitive edge in the market, one of the biggest edge that we kind of enjoy is our ability to do different kinds of blends, different kinds of products. And if you have noticed, we have always said that we build our capacity to our advantage in a way that it is very customizable. So that, so we really don't, while there are offers, we really don't want to acquire a setup which is very fixated in terms of its output, and then, diminishes our ability to be that much more nimble-footed in the market. Also, the position matters a lot, that are we in a zone which helps us to kind of, so today one of our other advantages are that we can import coffee from anywhere and export anywhere. So those things kind of, help to our advantage, and therefore we would like to maintain that advantage. So therefore it's like an if and but. If something right comes our way and we are looking to kind of, it fits into our scheme of things, we won't be averse to it. But going the way we have gone till now, it looks like, the principle would be to kind of build our own capacities going forward.
Got it. Thank you very much.
Thank you very much. In the interest of time, that will be the last question. I will now like to hand the conference over to management for closing comments.
Thank you all for attending the conference, and we look forward to meet you again in the next quarter. And thank you, Nirmal Bang, for arranging this conference. Thank you, everyone.